In this video, we'll cover investment in securities. So welcome back to our channel, Kano Academy. Please make sure you subscribe to this channel for more videos like this, and don't forget to press the like button to show your support. As indicated, we'll be covering business studies by discussing investment in securities under the following headings: the role and functions of the Johannesburg Stock Exchange, factors that should be considered when making investment decisions, the types of investments, their opportunities, as well as risk factors, the forms of investments, including their impact, the types of shares. We'll also provide descriptions of various investment concepts. As an introduction, let's start with the various functions of the Johannesburg Securities Exchange, otherwise known as the JSE. In this context, the JSE gives opportunities to financial institutions, such as insurance companies, to invest their funds in shares. It serves as a barometer, or indicator of economic conditions, in South Africa. It keeps investors informed on share prices by publishing the share prices daily. It acts as a link between investors and public companies. JSE shares are valued and assessed by experts. Small investors are also invited to take part in the economy of the country through the buying of shares. Venture capital market is also made possible under the JSE. An orderly market for securities serves as a disciplined market. JSE encourages new investments. It mobilizes funds of insurance companies and other institutions. It raises primary capital. It regulates market for dealing with shares. It plans, researches, and advises on investment possibilities. It ensures that the market operates in a transparent manner. It provides protection for investors. The JSE also encourages short-term investments and facilitates electronic trading of shares through strata. It also performs any other relevant related functions. Next up, we'll discuss the following factors that should be considered when making investment decisions, which are: return of investment, risk, investment term or period, inflation rate, taxation, liquidity, personal budget, investment planning factors, volatility or fluctuations on investment markets. Let's now discuss each of these factors in more detail. Return on investment, or ROI, refers to income from the investment, namely either interest, or dividends, or an increased capital growth on the original amount invested. High-risk investments yield higher returns. Generally, there will be a direct link between risk and return. The return should be expressed as net after-tax gains on the investment. Returns can be in the form of capital gains, where the asset appreciates in value over time. Another factor to be considered when making an investment decision is risk. Shares have low to medium risk over a longer investment period. Shares with higher risks have a greater potential for higher returns. Ordinary shares have the highest risk, as the investor may lose the full or part of the investment when the company is dissolved, bankrupt, or liquidated. Preference shareholders' risk is lower, as they have preferential claims on the assets of the liquidated company, and may receive some compensation before ordinary shareholders. Generally, share prices are linked to factors that investors cannot control, such as economic conditions, or the operational success of the company. Share prices are volatile, unstable, or unpredictable, and may increase or decrease sharply within hours, which contribute to the uncertainty of the value of an investment in shares on the short term. Another factor to be considered when making an investment decision is the investment period, or term. This refers to the duration of the investment, which may influence the return on investment. The longer the investment period, the higher the returns. The investment period will depend on an investor's personal needs. Short-term investments enable investors to access their money on a short period, if needed. The investment period can be short, medium, or long-term, depending on the investor's needs. Another factor to be considered when making an investment decision is the inflation rate. People are affected by a high inflation rate, because their money's purchasing power decreases. The return on investment should be higher than the inflation rate. Inflation has a positive effect on some investments, such as property or shares, where the income will increase as inflation increases. Personal budget is another factor to be considered when making an investment decision. A budget allows investors to determine the amount of surplus money that can be invested. They must therefore budget for unforeseen costs. Such budget should provide for contingency plans. Liquidity is also a factor to be considered when making an investment decision. Liquidity refers to how quickly and easily an investment can be converted into cash without losing significant value. Therefore, when making a decision on investment, an investor may consider an investment in a savings account or unit trust, due to the fact that it will be easier to convert into cash, rather than an investment in a fixed deposit, which is usually deposited for a fixed period of time. Another factor to be considered when making an investment decision is taxation. A good investment will yield good after-tax returns. Income tax implications must therefore be considered in order to ensure a high net after-tax return. Investors must keep in mind that tax rates are not necessarily the same for all investments. Investors must also consider planning factors. This means that investors should always consider the safest possible investment opportunities. Some investments offer a low income on invested capital, but this could be a safer investment than one that promises a higher income. So, investors must examine opportunities with a history of good return and divide investments between various investment options. The method of calculating the interest or return on investment should also be considered. Another factor to be considered when making an investment decision is the volatility or the fluctuations on investment markets. Fluctuation in national and international economic trends should be considered. The level of volatility will determine the amount of returns. Next up, we'll explore the various types of investment opportunities and some of the risk factors associated with each type. Starting with fixed property. Buying a house or a piece of land is usually suitable as a long-term investment only. Large fees and taxes are payable on these transactions, so property cannot be bought or sold every year. Return on property is earned in the form of rental, sales, and capital gains at a higher price than what it was bought for, including the transfer costs and taxes. The location and size of the property may also influence the growth in value over time. Fixed property is considered low risk over a long term. These risks may be determined by economic conditions and may influence the value of the fixed property. A stokvel is an informal savings scheme to which a relatively small group of people contribute. Each member takes a turn to draw from the stokvel for their own personal gain. There's little to no return on this investment type, as contributions are distributed monthly to one of the members. It encourages people to save each month for a specific reason. Banking fees are shared by the members, resulting in low cost of investment per member. When it is hard to get bank loans, stokvel payouts may come in handy. A stokvel is usually managed by a trustworthy chairman or treasurer, who will be responsible for keeping records and managing the bank account. Members usually discuss how the money will be invested and agree on the risks they are willing to take. The risk of stokvels is that they usually attract schemers who claim to be running stokvels but are actually running illegal pyramid schemes. So payouts may not be possible, as cash has run out, and members may lose their initial savings. Money in a stokvel savings account is a safe investment but with low interest rates, and the returns are low. Another investment opportunity is through a managed portfolio. This is when an investor instructs a financial institution, or bank, or financial advisor to manage his or her various investments and assets in one portfolio. If the portfolio does not perform well, or as expected, the portfolio, or parts thereof, may be changed with or without informing the investor. The risk of managed portfolios is rather low over a longer term. Investments are made in various sectors and companies. Therefore, the risk is spread and is better managed by the portfolio manager. Money is usually invested in the capital market, and unforeseen circumstances may impact negatively on the value of the portfolio in the short term. A fixed deposit is a very conservative method of investment. This is money invested at a fixed rate for a fixed period at a financial institution or bank. This invested money cannot be withdrawn, and sometimes cannot be added, during the period of the deposit. Investors have to be certain that they will not access or even need the money for the period of the deposit. The risk of fixed deposits is very low, as the investor will receive what was promised. As the interest rate is usually fixed, the return will also likely not be affected by market fluctuations. 32-day notice accounts, or call deposits, is when money is invested at a fixed rate. Withdrawals may be made, provided the bank is given 32 days notice for the withdrawal. It earns more interest than a current, check, or savings account, but less interest than a fixed deposit. These types of investments are low risk, because the investment plus interest will be paid out on the maturity date of investment. Interest is calculated on the daily balance, accelerating the value and the return on the investment, lowering the risk. Interest rate may fluctuate with market conditions, increasing the risk. Debentures are investments issued to raise borrowed capital from the public. The lender, or the debenture holder, agrees to lend money to the company on certain conditions for a certain period. Debenture holders are creditors, as the company is liable to repay the amount of the debentures. Most types of debentures can be traded on the JSE. Debenture holders receive annual interest payments based on the terms and amount of debentures held. Debentures have a low risk as they need to be paid back. Companies are liable to repay the amount of the debenture plus interest, which decrease the risk for the investor. Investors may earn a steady income in the form of interest while preserving their principal amount. Venture capital is given by an investor or businesses to start up or expand a business in return to have a share in the new or the expanded business. Investors should know the type of business, or the market, or the economic conditions, before a business is bought or started. Buying a franchise or existing businesses will be successful if the investor has done proper research and understand exactly what he or she is investing in. Business ventures and venture capital is high risk for investors, especially if research is not properly done. Inexperienced business owners that make wrong business decisions may experience big losses and closing down of an existing business. An endowment, or life insurance policies, or retirement annuities is when a monthly payment is paid to an insurance company with the expectancy of receiving a predetermined amount on future date, and to provide for future expenses and give peace of mind to the dependents of the insured. These types of investments are low risk because the insured amount will be paid out, regardless of circumstances. Only the closing down, or the bankruptcy of the insurance company, may result in losing the monthly contributions made up to the close-down date. Unit trust is a collection of investment options and methods, made up of shares in different companies. Investments from a number of investors are pooled together in a unit trust fund, managed by a fund, or portfolio manager, or expert. Unit trust can also be bought directly from the accredited service providers. Unit trust investments may be made in high and low risk shares, which spreads the risk throughout the fund, and this lowers the risk for all the investors and fund members. Fund managers are therefore able to manage the risk level of the fund on behalf of the investors. Companies sell or issue portions of its ownership to shareholders in the form of shares on the open market to obtain either capital or additional funds to operate its core business. Shares give the holder one vote per share and the right to receive a dividend, which is a portion of the profit. Companies do not have to repay share capital and is therefore risk-avoiding capital. Shares of listed companies are traded on the JSE. Shares can be bought and sold through brokers to whom a brokerage fee will be paid by the investor. Types of shares differ with respect to the claims to profits and dividends, including voting rights and claims to assets, should the company be liquidated. Ordinary shares can be divided into different types, for example, blue chip, bonus, growth, income, or defensive shares. Ordinary shares also have no special rights or restrictions and may yield higher dividends, but also have higher risk. Shares can also be preference shares, which can either be cumulative or non-cumulative, participating or non-participating, redeemable or non-redeemable, and convertible or non-convertible preference shares. Preference shareholders mostly receive a fixed dividend and are paid before other shareholders. Shares have low to medium risk over a long-term investment period. Ordinary shares have the highest risk as the investor may lose the full or part of the investment when the company is dissolved, or bankrupt, or liquidated. Preference shareholders' risk is lower because they have preferential claims on the assets of the liquidated company and may receive some compensation before ordinary shareholders. Share prices are linked to factors that investors cannot control, for example, economic conditions, the operational success of the company, etc. Share prices are volatile, unstable, and unpredictable. Share values may also increase or decrease sharply within hours, which contribute to the uncertainty of the value of an investment in the short term. To encourage saving, the South African government offers South African citizens an opportunity to invest in savings bonds. Two different types of bonds are available: either a fixed-rate retail savings bond or an inflation-linked retail savings bond. A market-related interest rate is determined when investment is made and remains fixed for the whole term of the investment. Interest is earned half-yearly, on the 31st of March and on 30th of September. This is paid out into the bondholder's bank account. A government savings bond cannot be used as security to obtain loans. So, creditors cannot have any claim on it. It can, however, be inherited by a nominated beneficiary when the investor dies. Since the government cannot disappear or go bankrupt, the risk on South African retail savings bonds is very low. This is considered a safe investment because it cannot be sold on the open market and is not exposed to market risks. Let's now focus on the positive and negative impacts of the various forms of investments. These various forms of investments include government retail bonds, unit trusts, shares, and fixed deposit. Starting with the positive impacts of government retail bonds. With government retail bonds, there are guaranteed returns because the interest rate is fixed for the whole investment period. Interest rates are market-related and attract more investors. Interest can also be received twice a year. Interest is also usually higher than on fixed deposits. Retail bonds are listed on the capital bond markets, on the JSE. This is considered as a low-risk and safe investment because it is invested with the South African government, which cannot be liquidated. There are also no charges, or costs, or even commissions payable on this type of investment. Investment may also be easily accessible, as cash may be withdrawn after the first 12 months. An investment in government retail bonds is an affordable type of investment for all levels of income earners, including pensioners. Retail bonds are easily and conveniently obtainable, either electronically, or from any post office, or directly from National Treasury. Investors younger than 18 years may invest with the help of a legal guardian, which encourages saving from a young age. Let's now cover the negative impact of government retail bonds. Retail bonds cannot be ceded to banks as security for obtaining loans. A minimum of 1,000 rands must be invested, which may be difficult for some small investors to accumulate. Retail bonds are not freely transferable amongst investors. Investors need to have a valid South African identification and sometimes should be older than 18 years, which may discourage foreigners or young people to invest. Penalties are usually charged for early withdrawals if the savings is less than 12 months old. Let's now discuss the positive impacts of unit trusts. Unit trusts are managed by a fund manager who buys shares on the stock exchange or JSE. These are easy to cash in when an investor needs money. A small amount can be invested per month. Returns on unit trusts generally beat inflation on the medium to long term. These are also considered safe investments as they are managed according to rules and regulations. With unit trusts, the investor also has a variety to choose from and a wider range of shares, from lower to higher degrees of risk. Unit trusts are easy to invest in, as investors simply complete a few relevant forms or invest online. Fluctuations in unit trust rates of return are often not so severe because of diversity of the investment fund. They also offer competitive returns in the form of capital growth and dividend distribution. Fund managers are knowledgeable experts, reliable, and trustworthy, as they are required to be accredited to sell unit trusts. Now let's cover the negative impacts of unit trusts. Share price usually fluctuate. These are therefore not good for people who want to invest for a short period. These are also not good for people who want to avoid risks at all costs. If blue-chip companies do not continue on their growth path, the growth of unit trusts will also be affected and will not render the expected returns. You may sometimes buy a unit for usually higher than the price you can sell it for, making the investment less liquid. Let's now discuss the positive impacts of fixed deposits. With fixed deposits, interest is earned at a fixed rate, regardless of changes in the economic climate. The period of investment can be over a short, medium, or long term. Investors can also choose the investment period that suits them. Principal amount plus interest earned is paid out on the maturity date. Fixed deposits also promote financial discipline, as investors cannot withdraw their funds before the maturity date. Investors also earn a better return on investment than on an ordinary savings account. The higher the principal amount and the longer the investment period, the higher the interest rate offered by a financial institution. Now let's cover the negative impacts of fixed deposits. Fixed deposits offer low returns as compared to other investments. Their return usually do not outperform the effects of inflation over long term. Fixed deposits investments can also not be withdrawn before the maturity date. Let's now discuss the positive impacts of shares. Shares can be freely transferred and traded on the JSE. Shareholders' liability to the debt of the company is usually limited to what was invested. Shareholders also have limited liability for company debts. Shareholders have voting rights at the annual general meeting or AGM. Investing in shares provides protection against inflation. Investing in shares can also provide solid returns at retirement age. Rate of return on investment is linked to the performance of the company. Ordinary shares are usually cheaper than preference shares on the open market. Holding a higher number of shares may result in higher proportional dividend payouts. Negative effects of shares are as follows. Shareholders may receive less dividends or no dividends when company profits are low. Companies have no legal obligation to pay dividends to shareholders. Risk may be high, as investment may be lost when companies are liquidated. Dividends declared may also be determined by the management or directors of the company or the business. We hope we were able to provide more clarity on the topic. If we have, please leave us a comment below this video, because we'd love to hear from you and what you have learned from this video. Also make sure you like this video and take time to share and subscribe for more. Until we meet again, happy learning. From all of us at Kano Academy.